Okay, well it is 6 o'clock sharp Pacific time, and we're going to start on time. So welcome. Thank you for attending. This is Module 1 of the Stock Options Basics course from Follow Me Trades. And we just finished up, we run this 6 weeks, and we just finished it up the first round this year, and it was great. And the feedback from the students was really, really good. So I'm really looking forward to this next round. I want to give a quick outline of, what you get in this course. If you sign up for the course, as a student, you'll have access to the secure area. There are 6 modules in the course. There's an introduction and then modules 1 through 6. And we actually have a recorded live option trading demonstration where we went in and placed orders and stuff and recorded that. But in like a module 1, each section has a page like this where you've got a written study material. There's a PDF that you can download, you can print out. It's got all the material for the module. There's a recording where I walk through all the material, do some teaching. And then there is like this one's got 2 parts to it. There's a quiz, there's an answer key for the quiz, and then for each module we do a live webinar like this, and the webinar is recorded. We'll record this one as well, and we'll post it up there. So quick outline of what's in the course is here, what's in each of the modules. So this is module 1 that we're talking about tonight, and we start really, really basic in the course. For some people this may be a review, maybe stuff they know, but it's just, I think it's important to lay a really, really solid foundation down. And for some folks they're starting with no knowledge at all, so it's important. And you can read ahead in the course material. All the modules are available to you. But we walk through this, week by week in the webinar. So week 1, we just talk about what are options, the basics, what are puts, what are calls, what are the risks. Module 2, we get into what does it mean in the money, out of the money, what are covered options, naked options. In 3, intrinsic value, extrinsic value, time decay, how option pricing is determined. And these first 3 modules are really foundational. And then in 4, we really get into it and we start talking about interpreting option chains, what the Greek values are, liquidity, and then contract selection. That really brings all that foundational material together. It's like, how do I pick the right option contract to trade with? Then we get into some more advanced stuff about, option pricing, again, the Black-Scholes model, how to project profit and what the price of a contract will be in the future, how to interpret symbols, different order types, and then we get into risk management, advanced risk management, underlying asset analysis, and an options trading plan. So that's a quick outline of the course. And with every week, every webinar, I give you a free pick, my favorite option trade for the week. And so be sure and stay on till the end because I'm going to show you a pick that we've got for tonight. And so if you're interested in trading that, I'll be giving the parameters of it. So with all that said, let's jump now into the material for Module 1. And please ask questions as we go along. Make it interactive. This course is really for students. So I'm going to go pretty fast through the material. Again, particularly this first module, some pretty basic stuff. If you join the course, you can download the PDF and you can study it, as slowly as you want. You can watch the recording again if you want. So I'll go fast. Again, if you got a question, please ask. And several folks have joined. I've started the recording. Just want to check one more time. Everybody can hear me okay? Everybody can see my screen before I continue? Type in a couple yeses, Y's there if you would. Okay, thank you. Good. We know Walter can hear me. So I assume everybody else can too. All right, Chris. Awesome. Thank you. All right, let's jump into it. So always a disclaimer, and I'm going to share a pick with you. It's important to get this out that I'm providing this information for education information purposes. It's not investment advice. I'm not a investment advisor. So I'm providing information, education. You have to make your own decisions. I don't know your situation or what is or isn't appropriate for you to trade. All right. So what is an option contract? Again, pretty basic, but not, everybody's starting at different places, so we'll cover it. So an option, when you say, hey, people, I'm going to trade options, an option is a contract. But it's not ownership of shares. It is a contract that gives you the right to buy shares or to sell shares, either a stock or an ETF. And it gives you that right to buy at something called the strike price. That's a predetermined price. And you get to do it on or before an expiration date. So option contracts have expiration dates. They don't last forever. So strike price, that's the agreed price that the buyer of the contract can buy or sell the underlying stock, ETF, regardless of the current price. And we'll show some examples. The expiration date, that's the date it's valid through. After that, it's expired. It has no rights or obligations. Okay? So call option. So if you think that a stock is going to go up, you have some kind of reality-based analysis, some reason for believing that a stock is going to go up, you can go buy the shares, of course, or you can buy a call option contract. And there's some good reasons for why you would want to consider buying a call option contract instead of the shares. And I'll give you a hint. There's two reasons. One is leverage. You can have less money in the market and leverage, a bigger position of stock than you can with cash, and your profits will be much larger, and you can limit risk. Some people really, when they hear about options, they hear about the risks of options. They do have risks. But with this very simple method that I'm teaching, you can really control those risks. And if all you're doing is buying calls and buying puts, your risk is exactly defined. It's very controlled. And it's actually less than owning the shares. That may be surprising. So here's a stock chart example. Here's Apple. And say at the end of October 2014, it's trading at about $100. And you got a reason, you've done some analysis. You say, I think it's going to go to 120 by December. So, wouldn't that be cool if you could go buy it at 100 after it goes to 120? Of course it would be cool, And then, wow, look, you're super smart. You were right. Your analysis was right on. It went up to 120, and Apple, it shot up there. And the really cool thing is, because you know how to trade options, you get to buy Apple at $100 a share while it's sitting up at 120. That's a pretty good deal. How's that possible? You're able to buy Apple at $100 in December because back in October you bought a call option contract with a strike price of 100. That's a contractual right that you paid for. You bought a contractual right. Somebody sold you that right. You can buy Apple at $100. Now that it's at 120, that's a valuable thing, right? Having the right to buy shares at $100 when it's sitting at 120 is a valuable thing. That's not free. You have to buy it. You have to pay for that right to buy shares in the future at a determined price, and that's called the premium. And premium is the cost to purchase the call option contract. And it doesn't last forever. This expires. So after that date, then you don't have those rights anymore. They no longer exist. And if the price of the stock had gone the other way, and you didn't get rid of the contract or sell it, which is we get rid of it, we don't let it go to zero. But if you held on to it until the expiration date and the price of the stock was below the strike price, it would have expired worthless and be worth zero. We don't let that happen. So how much profit would you make? So if you bought the shares outright, say you just went and bought 100 shares at $100 a share, it's $10,000 on the line. Right? And then you sold them in December at 120, you make $2,000, 20%. Well, nothing wrong with that. But if you bought an option contract, in October you buy one option call contract with a strike price of 100, expiration of January. So we want that expiration to be farther out in time than when we expect the price to go up. We don't want it to expire on us. Okay? So a typical premium would be about $500. It would cost you about $500 to buy a contract like that. So you got a $500 investment compared to a $10,000 investment. And let's say in December you exercise that option. You buy the 100 shares of Apple at 100 and you sell them right away for 120. You made $2,000 gross profit. Now you had to pay $500. You made $1,500 net profit. That's a 300% profit, right? Now you made $2,000 up here. You had $10,000 in the market tied up at risk. Down here you had $500 in the market and you made $1,500 net profit. Give me a Y if you think that's a good thing. Give me a yes. I think that's a good thing. Right? All right. We got one person thinks it's a good thing. Thank you. So put option is exactly the opposite. Now, okay, we got a couple people think that's a good thing. Put options are exactly the opposite. They work the same way, but the opposite. And sometimes people have trouble wrapping their head around it, but it's, you just keep it simple. Say you think a stock is going to go down. You can just sell some shares short, and that's a more complicated transaction. That's a margin transaction, and you're not allowed to do that in an IRA, by the way. You cannot sell stock short in an IRA, which is really a drag if you want to trade the market both directions. But the really good news is you can buy a put contract, and you can buy it in an IRA or an SEP, a deferred account, because, let's make your head spin, a put option, which is essentially a trade to the short side, is actually a long position. Don't get too hung up. In future modules, we'll cover that a little bit more, but it's true. It's a long position. You can absolutely buy put options and you can buy call options in an IRA account. So why would you consider it? It's just just the same. Here's Apple sitting here at July 2015. Say it's trading at 120 and you think it's going to go down to 100 by the end of the summer. And, wouldn't it be cool if you could sell it at 120 after it went down below 100? Sure it would. So, yeah, you're smart. Your analysis is right on. Once again, Apple tanked, man. Dropped like a rock down at 95. Okay? And because you know what you're doing, you get to sell it, sitting out here at 95, you get to sell it at 120 bucks. And you don't even own it. That's cool, I think. So, how much profit would you make? Well, if you sold the shares short, right? You sell 100 shares short at 120, it's going to cost you 12 grand, right? And then in September, when it went down, you buy to cover, and say at 100 bucks, you make $2,000 profit. Okay, that's not bad. 16.6% profit, 2 grand. That's nothing wrong with that. But if you'd bought the put at option contract, right? Let's say we buy in July 15, we buy one Apple put option contract, strike price 120, expiration of October, and we want to be buying contracts out past the date. We don't want them to expire. Cost us 500 bucks for premium, so we got $500 on the line instead of 12,000. And we were right, it went down, and in September we exercise the option and we sell 100 shares of Apple at $120 with the current price at 100. The broker does that for you in the background. You just go exercise the contract and the cash lands in your account. It's pretty simple. You get a $2,000 gross profit, $1,500 net because you had to pay $500 premium. So again, a 300% profit compared to a 16% profit. Now the total dollars are less, but look at the amount that you had invested, right? The amount of money that you had at risk in the market that you couldn't use on other investments. So I think that's pretty stunning myself. Okay, now that was part one. So let's just keep going. Switch. All my GoToWebinar panels are in the way of launching my files here. We'll get there. Okay, here we go, part two. All right. Everybody still with me? We already did disclaimer. So just some notes here, talk about stock option contracts. Most of them, they're for 100 shares, either of the underlying stock or ETF. The prices are quoted on a per share basis, but they're for 100 shares. So you'll see price quotes and option chains maybe for $3. The price you're going to pay for the contract to buy or sell 100 shares at the strike price is going to be $300. So it's always 100 times the quoted price. Ownership of an option, you don't own shares. You own the right to buy or sell shares. So you don't get dividends. You don't get to vote on, anything stockholders get to vote on, anything like that, right? You own the right to buy shares. You don't own shares. Now here's the cool part. I talked, the P&L examples I showed earlier were based on exercising the option, either taking possession of the shares and selling them or buying to cover, right? You don't have to do that. Absolutely don't have to do that. You can just sell the contract, right? The owner of an option can sell the option contract to a third party without ever exercising it. Don't have to buy or sell the underlying asset. In fact, that's how I rarely exercise a contract. I just sell I buy the contract. If I'm right about the trend, right? If I thought it was going up and I go buy a call contract, at my exit point, I have a predefined exit point, let's go sell the contract. And if you think back to the Apple thing that we bought for $500 when Apple was at 100, and Apple went up to 120, there's something called intrinsic value, and we're going to cover that in Module 3. There's intrinsic value. So if Apple goes from 100 to 120 and I've got the right to buy at 100, that contract is worth at least $2,000. That's intrinsic value, right? And the market maker will give me that money, right? Because that's the difference between the strike price and the current price. Again, we got plenty of examples. We go into that in more detail in a couple modules from now. But so that contract would be worth at least $2,000. It's probably worth more because it hasn't expired. It's got some extrinsic value based on volatility and the time left on it. Again, we cover more of that. So it's probably worth about $2,500. So I just got to sell the contract, right? And I can. There's market makers and there's a liquid market. I just go sell it. Never have to take possession of the shares. Bought it for $500, sold it for $2,500. All right, next trade. And I do that all the time, right? Now some lose, can't be right all the time. With my method, I win about 70% of the time. And I'll show you toward the end some examples of some open trades we're in with options. And I'll give you the pick for my favorite new one that's coming up. So this, there's some terminology around options that it's important to get crystal clear on. In this course, I teach a very, very simple strategy. If we think the stock's going up, we buy a call. If we think it's going down, we buy a put. I go through the details of how to select the best contract, how to manage the trade, how to manage risk. There's all kinds of other option strategies out there. So they can get really super complex, and there's spreads, and there's strange flying creatures, butterflies and iron condors and all this kind of stuff. John, it's going to be recorded, man, and I'll send it out to everybody. So, yeah, go put your kid to bed, man. Not a problem. Okay, so we teach a very simple strategy, right? And in this strategy, we only buy puts, we only buy calls. We never write contracts. But there's some terminology here around selling contracts. So I'll say I will sell a contract, but I only sell one that I own. And the same thing is when people write a contract, which certain strategies for writing contracts carries a tremendous amount of risk. In fact, it carries unlimited risk. Unlimited risk keeps me up at night, right? If I could lose more money than I have in my account, that troubles me. So I don't do that. So selling an option can either be writing the initial contract and taking on the obligation and all that risk, or it can be selling a contract that you originally bought. So there's some specific terms that are used for option contracts. We get into that, I think, in the order section. But so they've developed specific terminology, and when you buy a contract, it's called buy to open, and if you sell the one that you bought, it's called sell to close, and if you're actually writing a contract, it's called sell to open. So we can differentiate when we say sell what we're talking about. Okay. Capital efficiency, lower risk. So remember back in the Apple example, we spent 10 grand to buy the stock. So we had 10 grand in the market. It's tied up. Can't use it on any other investments. We did make a 20% gain. That was awesome. But we had it at risk. And anytime money's in the market, it's at risk. And, Apple's pretty stable, but, Apple has dropped like a rock sometimes unexpectedly on bad news, even though it's a big company, big popular company. So if you're sitting there with 10 grand in stock, and there's some really, really bad news that comes out, and what if it dropped, 30, 40, 50%? Well, you would lose that much, even if you had a stop order in place, right? Stop orders, if it gaps overnight, your order becomes active, and it's a market order at whatever it opens at, right? You could lose $5,000. You could lose half of your investment. That's, you know, it doesn't happen, you know, every day, but it happens with some degree of frequency to companies, right? So when you got your money in stock in anything, it's at risk, and it's also tied up. With an option contract, right, we had a 300% gain. We only had $500 into the trade, so we had $9,500 available for other investments. I think that's a good thing. And the other cool thing, if the stock were to drop like 50%, how much would you lose if you'd use call options? Anybody hazard a guess there? I know this is basic, and some of you guys already know this stuff, right? We'll get into the meaty stuff in the next couple modules. But anybody hazard a guess, if you're sitting there with, you spent $500 on a call option contract and the stock dropped 50%, how much would you lose? That's right, $500. That's the most you can lose, because you purchased the right, but not the obligation to buy the shares. So the most you're going to lose is $500. Now, no fun losing $500, but I'd rather lose $500 than 5,000. Right? So my risk is really, really tightly controlled. Now, if you were crazy and you spent your whole account on Apple call options and it dropped, well, that was a bad strategy, right? You were overexposed. Joe's saying, no, you still have time value in the option. Yeah, but if it's underwater, if say the strike price is 100 and Apple goes down to 50, it's worth zero. It's worth zero, man. Now, if it went down to 80 and we had time left, yeah, there'd be some time value left. I would agree with that, okay? But I'm talking about a dramatic example, okay? So you're actually right. You're not totally wrong, right? There is time value associated with options, absolutely, until they expire. All right. Yeah, we did that. So the risk, you know, there's no free lunch. There's no investment that you can get into, none, that don't have some degree of risk, right? The key to any investment, I think, is to understand the risk and to only take risk that is acceptable, and then to manage that very, very carefully. And so I teach a method for options for that. And we have a very basic, simple method for controlling risk on options, which is, you know, you only spend the amount in premiums that you are willing to lose. And I use a 2% rule of, you know, if I got a $100,000 account, I'm only willing to lose $2,000 on any given trade. And so I would only spend $2,000 on option premiums for a given trade. And if it totally goes against me and they go to zero and they expire worthless, I've lost $2,000, 2% of my account. No fun, but that's a manageable risk. I can come back from that, right? I do also teach an advanced method where we can take bigger positions and we can use some sophisticated tools and still manage our risk at the 2% level with a larger option position. But that's in Module 5. Okay. The primary risk of buying calls and puts is that they expire. So they have an expiration date. And if you haven't exercised them or if you haven't sold them, then the rights associated with that contract expire. And the contract, you know, on the day after it expires is worth absolutely zero. Okay. So here's an example. In January 2016, Microsoft trading at $50 a share. You think it's going to be, you know, by the end of March, it's going to be up at $60 a share. So you go buy 2 Microsoft call options, $50 strike price, April expiration, right? A month out from the deal. It's at $300 each. Total, you got $600 into the trade. You're wrong, right? Direction of the stock, by the expiration date, it's trading at $40 a share. Well, that's a drag. Contracts are worth zero. They're going to expire worthless, and you'll have lost $600, 100% of your investment. Okay, so that can happen. But, you know, what if you had bought, we said we bought 2 contracts here at $50 a share, right? If we had bought the shares, we'd have, what, $10,000 into that trade, 200 shares, right? I believe my math is right on the fly here, right? and our loss would have been much, much larger. So we controlled our loss here, even in the worst case example. So losing 100% of your investment sounds bad, but it only is if you've invested way too much. That's why we teach risk management and we teach how to manage that. Okay. And again, we're talking about buying contracts. The risk of writing contracts is different, it's higher, and we go into that a little bit more in Module 2. Okay. There's another risk associated with option contracts, and that's called time decay. I've said a few times that we want to buy contracts that are farther out in time than when we think the stock is going to hit our price target. And what we want to do, there's a curve here that you can see it's plotted from 90 days down to 0, and that this curve gets steeper and steeper and steeper, that the price of the option contract, the extrinsic value of it, right? There's two components to price: intrinsic, which is the amount that it's in the money. We'll get into that in the next two modules. And then there's extrinsic, which is based on volatility and the time left on it. So that time begins to, that price begins to fall off very sharply toward the end. So we really want to be out of this trade before this curve accelerates. And so we manage it, and we set our, we do our analysis on the chart, and we've got, a entry level and a target level and a stop level and a target date when we think it's going to hit our price target. And we want to be out of the position before this rapid time decay region begins. So if you haven't signed up for the course, if you're here just on the on the offer to come see the first class for free, there is a special running. Again, there's 6 modules. I'm going to show you just in a minute the results we're getting on our trades, on our option trades right now. I'm going to give you a free pick, and then we will we'll wrap it up. So let me again manipulate the GoToWebinar thing so I can see what I'm doing here. I'm going to put a link for this this offer. I'm going to put this into the chat area. So if you're interested in signing up for the course, of course I'd be happy to have you do that. I'm sticking it into the chat now. I'm sending it. Okay, there you go. And that comes with a money-back guarantee. And what that means is you get to access all of the module and materials. You get to come to this session. You can watch the recordings. You can do all that stuff. And that should give you a sense of what's coming, whether, the quality of the material, all that kind of stuff. If you proceed to Module 2, you'll get a warning, and you have to acknowledge, hey, when I move to Module 2, there's no more money-back guarantee. There's no more refund. I think that's fair. You get to come preview it. But once you really start consuming the rest of the course content, then no refund after that. So I've posted the link to that there. Now let's look at some trades, man. There's some trades we got open. So here's some real live option trades. I run a stock picking service. These are trades I'm taking with my own money, and I'm publishing to my subscribers. So we are in GLD. We're in that with the January. So we're looking at the end of this year, January 17, 106 call. We've been in this one just over a month, and we're at a 52% profit. We're in Starbucks. We've been in it just over a month, and it's going against us right now, but the chart on Starbucks looks like that's going to turn around, and we're out at a June 16 contracts. We got some time on this. This one ain't over by a long shot. We're in FCX, a mining company. Been in it 22 days, 36% profit, liking that. Joy is a coal mining company. We're in it 15 days, just over 2 weeks, 60% profit. Icon is a retail branding company. We're in them 2 weeks, 13%. And we just got into WLL last Friday. So we're just getting this trade started. It's down a bit, but I'm looking for oil. I know oil pulled back a little bit more today, but I'm looking for oil to explode just the way gold did. So I got this and a few more energy trades lined up. So pretty excited about this. And so this is fairly typical. We closed about 10 option trades already this year. back in late December and early January when the market was really coming down, we were getting into stuff like Caterpillar and Ingersoll Rand, Abbott Labs, Goldman Sachs, Apple, and we did really, really well. And we just bought puts, man, and let it fall. So we're pretty happy with this. Yeah, Joe says coal's hurting. Coal has been hurting for 3 or 4 years. It's recovering in a big time right now. The whole mining sector is doing really, really well. It jumped over the last 2 weeks. Pull back just a little bit, but that's normal. We're in a handful. We don't want to get overexposed in one sector, but we're in a handful of mining stocks. We're in deep profit. Some of them were just trading with shares. They're small caps. Okay, the next thing I wanted to show was the trade, right? The pick for this week. So Monsanto. This is a short trade, so we're going to be trading this with a put contract. Now, any of the picks that I publish, and I teach this in the course, right? I don't go into a trade without 4 pieces of data: an entry price that's represented here on this cyan line, a stop price where if it goes up, this is a short trade, so if it goes up to there, I'm out. The technical pattern, my thesis has failed. It's not doing what I thought it would do, and I'm going to get out and minimize my loss. I'm not going to let my put contract go to 0 and expire. I'm going to take a small loss and get out. Okay, so I got an entry price, a stop price, and a target price, this green line down here. So it has not hit my entry price yet. It came down really, really close. The resolution on the screen doesn't show a gap, but there is a gap there. So if price gets down to 83.72 on Monsanto, I'm going to go buy a put contract for this. And the contract that I'm going to buy is published on my website to my subscribers. It's right here. Okay. It's a July 2016 strike price 90, and that'll be an in-the-money contract. And again, the term in the money and how I choose the best contract to trade with, it's all coming up in future modules. I'll pay up to $9.75 per contract on Monsanto. So there's your pick for the week. It's a freebie. And you get one of these every week with the course, and we just hit a couple winners and you'll have paid for the course. So if Monsanto gets down to 83.72, then I'm going to go in and buy the July 2016 strike price 90 put contract for $9.75. If I buy that contract and price turns around and goes up to 93.26, I'm going to go sell it and get out and take a small loss. And what does the P&L on a trade like this look like? I whipped up a quick spreadsheet so you can see, because we're able to project, and I teach you how to do this in the class. We're able to project what the price of a contract is going to be at a future point in time. So the price is going to be about $9.75 for the contract at entry. If it turns around and goes the wrong way, the price of the contract is going to be $4.75, so we're going to lose about $500. If it goes down and hits my target, then the price of the contract is going to be about $21.21, so I will have more than doubled my money on the trade. And again, we can project these prices with pretty good accuracy. I teach you how to do that in the course. So I'll show you the option chain. This is what an option chain looks like if you have not seen one. Here's the Monsanto contract. Symbol Monsanto. We are in the July area of the contract. Here is the strike price 90. The puts are over here, right? It's currently sitting, to buy this would cost $665, but that price is going to go up as price gets down to my entry price. So I think it's going to be around that 975 number. Okay, and we go over how to analyze all these Greek values, how to pick, how to look on the chain like this and figure out what's the absolute best contract to buy based on the analysis of the chart. Average trade, Joe, I'm in at about 4 to 6 weeks is the typical time frame. Sometimes a little sooner, sometimes a little longer, but 4 to 6 weeks is very typical. It's been that way for about 3 years. And, our track record, last year the portfolio made 28.65, I think. Year before we made 36, year before 54. This year we've closed 10 trades. We're already at 12%. And with the open trades we got, with profit locked in, we're going to double it. We're going to be at 20% here as soon as we close out the trades we got open. And, of course, we're rolling into more. So we're off to a good start this year. That big market down move in late December and January we were on top of that. We saw it coming, and we got some really, really nice put option trades on that, and it was awesome to close those out and book some profit. So that's really what I had prepared, to present here. We went through it pretty fast. It is recorded. I'll send out a recording to everybody who registered, and whether you attended or not. So if you're interested in it, I'll send out the link again to sign up if you want to get into the course and proceed if you're not already in it. Johnny is asking, what would make this trade invalid? It's an awesome question, John. So if it goes up and hits the stop before it hits the entry, it's scrubbed. It's off. We're not taking it. Trade canceled. Joe's asked, yeah, I covered it. Or maybe you joined late, Joe. I don't use spreads, man. I just keep it super simple. I know there's a place for them, and people can do what they want. Again, my disclaimer is I'm showing you what I'm doing. I'm providing information, education. I'm being transparent about the trades I'm taking. I can't advise you on what to do, but I don't use spreads because I like a really simple. The trouble with me for spreads is the profit is fixed. There's a max amount of profit you can make, and it's usually pretty small, a couple $100, right? Where if I have correctly identified a trend, I'm mostly a trend trader. If I've correctly identified a trend and I go short on it, I go long on it, the amount of gain I can make is way, way more than a spread where you've got, offsetting, I bought a call, sold a put or something as protection, right? I don't need protection because I'm going to get out of it. And because I manage the risk by my position size, or I'm not putting more into the trade than I'm willing to lose. Or if I do take a bigger position, I've got a really clear method to control my risk and to be out of that thing before I take a bigger loss. So I'm more profitable with this strategy than I would be with spreads. The long answer. Any other questions?